Crypto treasury companies have been all the rage in recent months, with investors getting excited at the prospect of an institution buying up billions in BTC or their favorite altcoins. But many have started asking, what happens if crypto treasury companies start selling? Well, the answer isn't far away, because some crypto treasury companies have officially started offloading some of their coins and tokens. So today, we'll tell you about what's been going on, including which treasury companies are selling and which cryptos could be hit the hardest. My name is Guy. Stay tuned. First though, I'm not a financial advisor and nothing in this video is financial or investment advice. It's educational content intended to inform you about crypto treasury companies. So if that sounds good, prove it by punching that like button and let's get into it. Now, digital asset treasury companies, or DATs, have proliferated in 2025 far beyond what anyone was expecting. Almost every other day, a new company appears out of nowhere and announces its crypto reserve strategy. Now, of course, the OG DAT is MicroStrategy, now just Strategy, which first scooped up BTC back in 2020. And Strategy has since inspired a plethora of other companies to start stacking sats. And as you'd expect, DATs have since expanded into altcoins, which has been bullish for the alts they've acquired. However, it's only bullish so long as these DATs continue buying. The moment they start selling, that bullish trend can change very quickly, and, well, that's what now seems to be happening. In case you missed the news, ETHZilla, a treasury company that's been accumulating ETH, sold around $40 million worth of ETH on the 27th of October. This was done so that it could buy back around $12 million worth of its own shares. Notably, this is part of a $250 million buyback plan, which suggests that more ETH sales could be imminent. More on that in a moment. Now, another treasury company that's recently sold its crypto was Seconds, a semiconductor manufacturer that's been accumulating BTC. Seconds sold off 970 BTC, worth over $90 million, on the 4th of November in order to redeem 50% of its outstanding convertible debt, which was valued at $189 million. Naturally, this begs the question of why ETHZilla and Seconds started dumping their assets. Although each company technically has a different reason, the answer is essentially the same. Their NAV has been falling. Now, for context, NAV stands for net asset value, and it measures whether a company's stock is trading at a premium or a discount relative to its crypto holdings. For both Seconds and ETHZilla, their NAVs slipped into negative territory, meaning their shares were worth less than the assets backing them. As such, they basically sold crypto to try and balance that ratio. Case in point, Seconds CEO Dr. Georges Karam explained that, quote, "This initiative has enhanced our financial flexibility, meaningfully reduced our debt-to-NAV ratio, and boosted our ability to execute our buyback program." Notably, though, this move came shortly after Seconds reported that its Q3 revenue had plummeted by a staggering 47% compared to Q2. Ouch. Similarly, ETHZilla's CEO, Makandrew Rudisill, explained that, quote, "By opportunistically repurchasing shares while our stock is trading below NAV, we plan to reduce the number of shares that are available for stock loan/borrow activity while increasing the NAV per share of the company." What's crazy is that just days before it sold, ETHZilla's NAV was trading at a 40% discount. Now, the good news is that, assuming these sales achieve their intended goals, then both Seconds and ETHZilla will be able to continue stacking BTC and ETH respectively. Both companies say that is the long-term goal. The bad news, though, is that if things don't go according to plan, both companies could end up selling more crypto to stay afloat. This could do some serious damage, especially if they're forced to liquidate all of their positions. For perspective, Seconds currently holds 2,264 BTC after trimming its treasury by roughly 30%, with those holdings worth around $230 million. Meanwhile, ETHZilla now holds just under 94,000 ETH, following a sale of about 8% of its reserves. That remaining ETH is valued at approximately $321 million. Obviously, what happens with these companies could create lots of volatility for BTC and ETH. And if you'd like to trade this volatility, then you have to check out the Coin Bureau deals page. That's where you'll find exchange sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. Just hit the link in the description or scan this QR code, which will take you to the deals page. There, you'll see all of our offers across a range of exchange partners. Simply click one of the Sign Up Now buttons, and that should take you right to the deal. These deals won't be around forever though, so take advantage of them while you can using the link in the description below or by scanning the QR code on screen now. Now, even though only 2 crypto treasury companies have sold some of their holdings thus far, this has created uncertainty across the entire digital asset treasury space. The crypto market is looking pretty bleak right now, and nearly every DAT is feeling the pressure. So, which cryptos could be hit hardest if other DATs start offloading their assets too? Well, naturally, the first is Bitcoin, since it's the most widely adopted treasury asset. As I record this, 190 Bitcoin treasury companies hold at least one full BTC on their balance sheets. Altogether, they control over 4 million BTC, valued at roughly $108 billion. Obviously, the lion's share is held by Michael Saylor's strategy, which owns more than 640,000 BTC, possibly even more by the time you're watching this. The second crypto that could be hit hard if DAT starts selling is Ethereum. For reference, there are currently 71 Ethereum treasury companies, collectively holding 6.1 million ETH, worth around $21 billion today. More than half of this is held by Bitmine alone, which holds 3.4 million ETH, worth over $11 billion. Now, believe it or not, but the third crypto on the list is XRP, currently held by 10 treasury companies. Together, they control around 2.1 billion XRP, valued at $11.5 billion. In fourth place, we have Solana, with 20 dedicated treasury companies holding over 20 million SOL, valued at $3.3 billion. Toncoin is a surprising fifth, with 3 treasury companies stacking 568 million ton, worth $1.2 billion. Another surprising crypto on the list is BNB, with 2 treasury companies holding a total of 608,000 BNB, valued at $600 million. The surprises keep coming too. Avalanche has 2 treasury companies, one public and one private. The public company holds over 400,000 AVAX, while the private company holds significantly more, though exact numbers aren't disclosed. Combined, though, their holdings are valued at around $560 million, suggesting the private company likely holds roughly 30 million AVAX. In any case, Sui also has 3 treasury companies holding over 100 million Sui, valued at $232 million. Meanwhile, Tron has just 1 treasury company, which holds 677 million TRX, worth $220 million. We also can't forget Dogecoin, where 2 companies have accumulated 780 million Doge, valued at $140 million. The list goes on. Litecoin's LTC, Betensor's Tau, and even the Bonk meme coin each have DATs holding tens of millions of dollars worth of tokens. And given how quickly the DAT landscape is expanding, there are likely others we've missed, and possibly new ones created by the time you're watching this video. The point, though, is that collectively, these treasury companies hold hundreds of billions of dollars worth of crypto. So the question is, if Secons and ETHZilla are just the first dominoes to fall, could the crypto market absorb a sudden supply shock if more DATs start dumping their crypto?
Well, it depends.
If these companies start offloading their tokens to retail investors on the open market, the chances of the crypto market avoiding a plunge into bear territory are slim. Such selling would not only trigger brutal red candles, but also signal to investors that the model simply doesn't work. This could create widespread chaos and uncertainty in both the DAT industry and the crypto market, likely sparking additional panic selling that amplifies the downward pressure. However, if DATs choose to sell their reserves over the counter, or OTC, the crypto market could theoretically handle it much more easily, assuming the demand is there. That's because OTC trades don't immediately impact spot prices, since they occur outside of public order books. That said, the spot market could still be affected if the recipients of these OTC trades later move their crypto to exchanges. Thankfully, this is all hypothetical, for now at least. But this brings us back to the stark reality of the situation, which is that DATs across the board are struggling, and not just in NAV terms. The stocks of these DATs have fallen a lot in recent months, even the largest ones. To put things into perspective, Strategy's MSTR has significantly underperformed BTC's price action since early September. So why are DATs struggling so much? Well, the answer lies in market saturation. The rapid rise of DATs has diluted demand for each individual Treasury company, raising serious questions about the sustainability of the crypto Treasury business model. As a result, their NAV premiums have either dropped sharply or fallen into discount territory. And this is important because an NAV premium can attract new investors. Logically, a premium occurs when the market values a company's shares above its underlying assets, often reflecting confidence in management, investment performance, or financial stability, including factors like the ratio of reserve assets to total debt. Put simply, the higher the NAV premium, the more attractive the company is to investors. Now, thankfully, a company can boost its NAV per share by raising capital to buy more crypto. Most companies follow Strategy's playbook and issue convertible notes, basically debt instruments that can later be converted into shares, often at a discount. This allows DATs to raise funds quickly, but also causes dilution when the notes are converted and new shares hit the market, which can dampen investor sentiment. And it goes without saying that sentiment hasn't been helped by the 10th of October crash, which saw a record $20 billion liquidated from the crypto market, driving prices down and, by extension, the value of these companies' reserves. But there's a simple method that DATs can use to remedy the situation, and that's share buybacks. As a fun fact, the DAT share buyback trend started at the end of July this year, when Ethereum treasury company Bitmine announced plans to buy back $1 billion worth of shares, either on the open market or through negotiated transactions. On the 22nd of August, another Ethereum treasury company called SharpLink announced that it would buy back $1.5 billion worth of shares instead of accumulating more ETH. The company said it would use its available cash, staking rewards, and, quote, alternative forms of funding. It also noted it won't use an ATM program while its stock trades below NAV, though that could change if market conditions improve. SharpLink began buybacks on the 9th of September, repurchasing around $15 million worth of shares. Anyway, ETHZilla authorized a $250 million buyback program on the 25th of August, and specifically mentioned the option to sell ETH to fund the purchases. And as mentioned earlier, ETHZilla completed its first $40 million share repurchase on the 27th of October, and it probably won't be the last. Meanwhile, on the 12th of September, the TON strategy launched a $250 million share buyback program and simultaneously announced it would stake its TON reserves to generate additional revenue, potentially funding even more buybacks in the future. On the 24th of September, Thumbs Up, which holds BTC and Doge, announced it would expand its $1 million share buyback program to $10 million. That very same day, DeFi Development Corp, a Solana treasury company, expanded its buyback program from $1 million to $100 million. 4 days later, on the 28th of October, Metaplanet, the fourth largest Bitcoin treasury company, announced a $500 million share buyback program backed by a Bitcoin collateralized credit facility. The company said it plans to maximize Bitcoin yield per share and restore market confidence. Then, on the 4th of November, Metaplanet confirmed it had secured a $100 million Bitcoin-backed loan to fund share buybacks and further BTC accumulation. Now, in most cases, the company in question's stock price has rallied following a share buyback announcement, largely because these moves boost investor confidence. In other words, DATs are racing to strengthen the credibility of their businesses with buybacks, and this seems to be working, for now at any rate. As you might have guessed, though, share buybacks aren't always the silver bullet they seem to be. They can leave DATs with reduced cash reserves or higher debt, and if the buybacks fail to lift NAV back to a premium, the companies may ultimately be forced to liquidate assets to stay solvent. Needless to say, this would be bearish for the cryptos they hold and could trigger further panic selling, keeping prices suppressed for longer. And this begs the question of what other methods DATs can use to stay afloat. One option, as touched on earlier, is staking. For companies holding cryptocurrencies that can be staked, such as ETH, SOL, TON, BNB, and a few others, staking millions or even billions of dollars worth of that particular crypto can potentially generate millions in staking rewards. The catch is that staking most of these cryptocurrencies involves long lockup periods, leaving companies exposed to volatility and potential opportunity costs before their staked assets become available again. On top of that, selling staking rewards could further suppress prices if market conditions aren't favorable. Another option for DATs is to borrow against their holdings to raise capital for acquiring more crypto. This leveraging strategy is famously used by Michael Saylor's strategy, allowing them to accumulate ungodly amounts of BTC. Other companies can adopt the same approach to quickly grow their holdings, which can significantly support their NAVs, assuming crypto prices move in the right direction. However, this leverage also exposes companies to greater downside risk if the price of the crypto collateral they used for these loans falls. More importantly, using crypto reserves as collateral introduces the risk of liquidation, i.e., forced selling. If these positions are liquidated, DATs could be forced to sell some or even all of their remaining assets. And it's safe to say that DATs can also quickly raise capital by issuing more equity. But, as we've seen, this requires a strategic approach, since issuing too much stock can dilute shareholder value. However, if done correctly, DATs can raise substantial capital without having to liquidate any of their reserves. I'd also be remiss if I didn't mention that some companies actually have revenue streams from pre-existing businesses that can help. While this doesn't apply to pure-play treasury companies, many DATs had established business models before adopting crypto reserves. Cash flow from these ventures can be used to buy back shares, accumulate more crypto, or simply bolster the company's cash reserves. The caveat, though, is that redirecting operational cash means it's no longer available to reinvest in the core business, which could risk alienating core investors. So, by now, it's clear that while crypto treasury companies can be extremely bullish for the assets they hold, they also carry inherent risks. But even with the news that some DATs have started selling, it's not all doom and gloom. It's easy to forget that there's more to the crypto market than these treasury companies. There's also the spot crypto ETFs, for example. As we all know, the spot Bitcoin and Ethereum ETFs have seen significant net inflows, helping both BTC and ETH rally. For Ethereum, the upcoming staked ETFs will likely attract major institutional capital by offering large investors opportunities to earn a yield. And if you've been following the channel, you'll also know there's a growing number of altcoin ETF filings that could be approved imminently. As I record this, the US government shutdown is the main obstacle delaying their approval. But once the shutdown ends, many of these ETF applications are expected to get the green light. This could help boost the price of many of the altcoins held by DATs, potentially creating a positive feedback loop where spot altcoin ETF inflows push up altcoin prices, which push up DAT prices, which makes it possible for them to buy more altcoins and so on. Oh, and by the way, you can learn more about the pending ETF applications in the video right over here. So then, should we be concerned about DATs? Well, the short answer is no. While some treasury companies are showing signs of strain, many are taking proactive steps to continue accumulating crypto, and there's no signs of panic, at least not yet. But what do you folks think? Are DATs doomed to fail, or do we all just need to chill out a bit and look forward to the good times ahead? Let us know your thoughts in the comments below. And if you want to learn what caused Bitcoin to crash recently, then check out the video right over here. And if you're wondering if altcoin ETFs could drain liquidity from their treasury companies, then check out the video right here. But that's all from me for today, folks. Thank you all so much for watching, and I'll see you in the next one. This is Guy, signing off.